Good evening, guys. Ken at Tortoise Capital. This is the nightly strategy podcast for September 16th, 2020. Let's get right into the, let's get the lesson started first. Before I forget. Here we go. Excuse me. Okay, so yesterday we reviewed the personal learning journal, target identification, the logic chain, daily prep, and daily time management. So today, strategy number 5. And remember, a strategy is an approach to general problem solving. It lays out the broad outlines about how to proceed. And that's opposed to a system, which is a very precise set of rules that could be robo-traded and could be pseudo-coded into a precise science. So I want to draw a picture here. All right, so number 5, creating your daily logic chain. And this is your strategy to respond to observed price behavior in the markets and sectors that takes into account your usual suspects, or the things you usually trade, your continuation patterns, and any new signals that are generated by your strategies and systems. This refresher of your basic template refines your daily preparation. So I want to follow the logic chain now, the conceptual map of how we get to the daily logic chain. Okay. So we start over here with the herd, and that is a subset of the great big world of possibles. That's all the symbols in the world out here. And so you carve out a subset of those in this approach. So it is a good sample of a lot of different sectors and markets and asset classes. So you've taken a sampling of the world. So nothing can happen in the world that you don't have some insight into because of the way that you constructed your herd. And so the herd, in my opinion, is anywhere from 50 to 100 targets. And again, that's going to be broken down into certain little sectors and subgroupings and so forth. So you have a manageable set of symbols. And these are designed to give you something to do in every kind of market, because something will be moving in the way that you like to trade. So that's one of the things that we look for in what constitutes a good herd. There's always something to do. And there's nothing happening like in this sector of the world, that's not reflected in at least a sample of that sector being put over here. And that's the real value of ETFs, by the way, is that they give you that ability to get broad exposure to asset classes. So when we think about the market, and then we think about sectors, and then we can think about components of sectors, the individual companies that form that third layer down. So when we do our daily plan, we're taking look back and seeing what's going on in the market, in our herd, and in those sectors. And we say, aha, when we run our screens, we found maybe 4 or 5 or 10 different individual targets that are good to go. Each one of these meets our criteria for being tradable the next day. So now we have our set of targets, which we are going to trade frame in a standard way. We're going to see that on number 6. Okay. And those symbols that were in this herd are really coming from 3 sources. Usual suspects. So the things like frog champions and the big broad indexes that we always want to trade, we're always prepared to trade. So number 1. Number 2 would be any continuation pattern. In other words, it was a trade frame yesterday and it worked today, and that trade frame is still valid, and we're emotionally and analytically committed to it. So we understand the frame already, and we can just build on the new information that we got today, and the signal is still valid. And then number 3 would be any new signals that are generated by systems or strategies. So we have a whole bunch. We have a whole bunch of systems over here, and we have a whole bunch of strategies. And we have them for the core, which is like monthly rebalancing. We have them for swing systems, where we're looking at 1 to 10 days. And we're looking at day trading, where we have systems like the frog and the owl and P1 through P7 of the RLCO. So we have a lot of different mechanical systems. So in the swing trade, that's where we have like the 5-day down, washout, etc. I covered that yesterday. And then these systems like BMR and the 6 mechanical swing systems plus continuation pattern gives us 7 very strictly structured systems to trade with very specific rules. So we have different time frames: core, swing, and day. And then over on the strategy side, this is where we have the more relaxed rules. They are really more like guides and principles, and some adjusting to fit. So it's adaptable under strategies. There's strategies could be developed into specific systems if you wanted to get more precise with the parameters. You can turn every strategy that we have into a particular system that fits you. And each strategy could develop into multiple systems. Like I could do 7 or 8 different variations on the 5-day down system. Or I could take the auto framer strategy and I could turn that with precision into a dozen different systems. So strategies are relaxed guides, systems are mechanically pure, and then you can decide between 100% rules-based and 100% discretion where on that you want to be. Like if I was here, I would be mostly rules-based and only a little bit discretionary. Here would be that perfect balance point, 50% rules, 50% discretion. So we have strategies for the longer term systems, for swing patterns, and for day trading. And the beauty is that these are all fractal. So the patterns that you learn in any time frame, core, swing, or day, can be applied to any time frame and can be modified for systems and strategies. So when we talk about managing the herd, what we're really doing is we're getting a lens and looking at the behavior and the condition of those targets, potential targets that we have in the herd. And we use those filters to cut out a certain number of them to become our targets. So we have the usual suspects, continuation patterns, and any new signals that are generated by our strategies and systems. So now I have this collection of targets that I need to frame. So when I go through the framing process, as I'm going to describe in number 6, I'm answering the 7 questions. I'm setting up mechanical entries to go long, to go short. I have the unit of risk, maybe that's an MMRB. Where's the reasonable targets? What is my strategy to trail? If it gets up to my target and starts to fail, am I going to use the 2-hour battle drill? Am I then going to go short, or would I not go short? And then how would I re-enter if it continues? So all of those things go into answering the 7 standard questions of trade framing. So once I've built an individual trade frame for each of those targets, maybe I have 5. Those are not 5 separate things. Those are still related to this notion, this hierarchical notion of the market, which generates 50% of the variability. It's the variability and the volatility that creates directional movement. And so 50% of any company's price movement that day can be attributed to the market. And we just generically call that SPY for the world of equities. And then 25% can be attributed to the sector. And then 25% can be attributed to the company itself. So you think you're studying Intel or AT&T, and if you just learn everything there is to know about AT&T, you'll be smarter than the average bear, and you'll be able to trade that because of how much prep you put into Intel. But that Intel-specific prep is only worth about 25% of the explanation of the price moves of the next day. So if you are neglecting markets and sectors, you're missing the majority of the reasons why that price is moving around. So if we take the broad market and the sector and then the company, we can actually see the synergy between those and then see all of the price movement in one. So when we're talking about creating the daily logic chain, what we do is we take those 5 targets that we framed and then we construct something like this. We say, I need a plan on my dashboard to see what the market is doing. Is the market going up or down or sideways? And then once I know that, since I know that's going to contribute volatility and directionality to the targets that I'm trading, I can also, say what are the sectors doing? So let's say that I want to trade Intel. I know that Intel is part of XLK. That's the S&P Spider for technology. So when I'm constructing my trade frames and my logic chain, I want to have a way that my dashboard of indicators has some room in it so I can see what the S&P is doing, and then I want to be able to see what the sector is doing. So I want to be able to see what Intel is doing. So even if Intel is the precise target, I also have to take a look at how do I gain information about the S&P and about technology. And the way I find the mover then is I can start constructing scenarios. And I say, if the market is up, and then if XLK is greater than the market, so if the S&P is up this little much, and XLK is up that much, I can say, well, this much of the sector is coming from the S&P. The S&P is just contributing to that gain. But this extra little piece in here is what the technology sector itself is producing. And then if I notice that Intel is ahead of the market, I can say, well, this much of Intel's move is generated by the sector, and this much is being generated by the market. But this extra gain is people that are actually buying Intel above and beyond what the sector and the market are doing. So now I have a logic chain that allows me to go from what is the market doing, what is the sector doing, and then what is Intel doing, what is the target doing. Now, if I want to exclusively trade ETFs, I can even further simplify my life because I don't have to worry about the company at all. And now, in that case, the market would be worth about 66%, or 2/3, and 1/3 would be attributed to the sector itself because of math. So what I'm talking about now on this daily logic chain, this like radar screen, is that I take those symbols that I want to trade and I array some kind of logic chain that gets me from the market to the sector to, and maybe I'm trading Intel, Apple, and Microsoft. So I go Intel, Apple, and Microsoft. Well, that's going to be very efficient because I only got to study, XLK and SPY, and I say if the S&P is flat but XLK is up, then clearly people are buying technology as a sector. And then I can go to these three and say, which one of them is moving the most? And say, that's the one that has the most buying pressure, and maybe it's Microsoft. And so I can find the symbol that is receiving market information and buying pressure in the sector and the company itself. And that turns out to be the lowest risk idea, is I'm finding alignment between market, sector, and target. So when I construct my little daily frame then, what I need to do is get a radar screen that has the S&P, and then maybe the sum total of my sectors is maybe there's 4 sectors that I care about, and maybe each one of them has 2 additional symbols. And then that's what I mean by assembling your logic chain. Then I can rehearse that and then make sure that my dashboard includes all the indicators I need to be able to distinguish between good performance from the sector or the market or the symbol itself. That's what I mean by finding the movers. I need to be able to find the movers. So now when I'm talking about standard trade framing, come on screen, work with me here. So now when I'm talking about the standard trade framing, this is that part of the supply chain where I took my herd, I found my set of targets that met my criteria that I like. I framed them all in the standard process. Then I constructed some kind of logic chain between the market and the sectors that I'm interested in and connect those to the symbols in each sector. And then I can set up my rehearsals and my scenarios where I say, if the market is up, what do I want to do? If the market is down, what do I want to do? So I need to have some symbols that I can trade so that when the market is down, what are the things that are inversely correlated? Like, what if the S&P were down, but XLF, the sector, the finance sector, was up? Maybe it's just the market was going down, but XLF had already bottomed out, and that was starting to move up. Well, clearly, people are buying XLF even as the market's going down for other reasons, and so then maybe I can go to Goldman Sachs. But in this case, I would be very careful because the gains in XLF are being offset by the losses in SPY. So I'm thinking that the follow through may not be as big. So I have to be judicious. Whereas if the market was up, but XLF was up more and Goldman was up even more, then Goldman is easy to believe in because all signs are pointing to yes, everything is pushing it to the upside. So the trade framing then are the specific scaffolding and decision points that we build, a series of structured questions that cause us to frame the trade in both directions. So we're ready for, remember, because we had something like a critical state that maybe ended in a doji. And so the critical state is what we want, because then we have a higher probability of a large directional move in short periods of time so that we can get the maximum gain in the shortest amount of time. So if that's the case, then I have to be prepared to trade in either direction. So I don't have a directional bias. I can just let price pull me. So if here's my trade frame, and there's my MMRB, minimum manageable risk box, and it goes this way, and it pulls me up to no lose plus dinner for two. Now I just have a science project because I've now gotten my risk. Or if it failed, I can then get to no lose plus dinner for two this way. And now I have a science project because I've locked in some gain that paid me for the round trip plus $100. And now I just got paid $100 to see how much more I could get out of there with skill. That's a good problem to have. So that standard trade frame then makes us ready to trade in both directions, to establish risk and reward parameters, minimum 2-to-1, to identify the locations of probable decisions, and that comes from the multi-time frame, multi-lens analysis, where we look at, among other things, support and resistance, pinch and stretch, RLCO patterns. We look at, let me clean that up. RLCO patterns. We look at MACD histogram and MACD 4 seasons. And we look at the regression line fractal framework. Those 5 different lenses give us the ability to create the scaffolding and the structure that helps find places where we wouldn't be surprised to see the trend change. And then if we know where those known points are, that's why they're known points, then we can rehearse our decisions based on the environmental frame that we created with this lens. And that's where the 2R battle drill is so crucial, because that gives us a way to rehearse all the decisions we need to make for the trade that we hope to see. That should be the most rehearsed decision of all. So we want to do all of those visualizations and rehearsals before we're into the trade, so that we don't have to spend any cognitive effort under stress trying to decide, well, should I get out? Where will I get out? When do I re-enter? And do I stop and reverse? I want to have all that rehearsed in my trade frame so that in the moment, all I have to do is execute. So when we think about plan, prepare, execute, and assess, you can now see all of those steps in these 2 strategies. Going from the herd to the symbols of interest is planning. Preparation is how I frame them and I prepare the logic chain. Execution is how I just execute the plan based on whatever price has to do. I just have to sense and respond. because I've already mapped out all the decisions I'm going to make. I don't have to do any thinking. So execution is just following the plan. Frame the trade, trade the frame. And then when I'm done, I can assess how well I planned. How well did I prepare? How well did I execute? And then how well did I conduct my assessment? And live to fight another day. And that's why step number 0 in this process was the learning journal. That's where all of this stuff goes so that I can sustain, improve, and act according to my priorities and my updated task list. So you can see how these things build upon each other. So I didn't mean to erase that. All right. So that's all I'm going to cover for tonight, 5 and 6. Tomorrow we're going to do position sizing versus execution, then trading as a skill-based activity, because this is going to get into the management of risk. Okay? So there we are. Hopefully you guys found that refresher helpful. Eugene, you're probably having flashbacks from the hybrid workshop. But that becomes like hearing your favorite song on the radio. I hope it's your favorite song. Okay, so let's take a look at where we are. This is the market on daily charts. So yesterday we spent some time talking about the importance of the skin of the dragon, the upper skin of the dragon, and that 30-period regression line projection, and then this series of declining PSAR dots. So this is going to be where the PSAR is tomorrow at PSAR +1, which co-locates with the Z1 score at 346. And then we've noticed how the dragon has rolled over. And during the entire bullish move up, that dragon acted as a force, a boundary to keep that thing trending until it no longer could. It got to an exhaustion move, and then price penetrated the dragon and got down here. And now you can see the value of that smooth RL10 and how nicely that traces the main body of price. So until we get through the dragon, this is a noise boundary that that keeps us locked in. Oh, come on. This stupid machine. Sorry. Sometimes that snipper locks up and I have to reset the site picture here. So this price action, you know, as we watch the RL10 has turned into the fall, and now is still in the fall, but has started to curl back up. That RL10 is the real price. And we notice that it just crossed the baby dragon to the upside. So that baby dragon is the simple moving average 3 of the RL10. And we notice that the PSAR, which demarks the trend boundary. So this was today. That was today's PSAR. And so this is what we would project as tomorrow's PSAR. It just, again, happens to be co-located with Z1. So that's at 346.86. And so as this price goes out into the future, we have to see that RL10 continue to improve. And then if it was something like that, if it was a perfectly rational line, we might think that tomorrow, the next day, and the next day, by about 4 days from now, if everything else remains true, that RL10 could cross the PSAR, and now that PSAR would flip, and then it would come down to right about here, because it comes to the bottom of the RL10. And then this is where the new PSAR would be. And then if this thing really were to continue up, that PSAR would slowly start rising and would act almost like an energy bar and just starting to push that stuff north. But until it gets through that PSAR, until it gets through the dragon, then all of the price action in this area is just noise in terms of the swing trend. So it has to get through that dragon, and it hasn't. And today it gapped up, came up here, and then sold off sharply. So this little price move here is now creating a pocket. And at the base of the RL10, oh, I'm sorry, it's down here. I obscured it. This is where the collapsing dragon takes over, which is almost co-located with a 10-day low and a 30-day low. Down here, call it 331. So if 331 gets breached, I'm sorry, that's 333 is the belly of the RL10, and 331 is the 10-day low. So if those two price levels breach, this thing is going to be a huge sell-off. So what we're stuck in is in the middle of this choppy tactical trading. There's no swing trade until it either gets out of the dragon or it firmly rejects and leaves the dragon. So this little region in here is all about the day trade and taking advantage of short-term opportunities. Now, what's nice about day trading in this particular market condition, when we've had a really strong bull and people want to preserve their profits, so they want to lock in, they have some selling pressure because they want to lock in their profits. But the further it comes down, the more there is an urge to buy so that they can buy quality on dip. So at the end of a strong bull with a significant pullback, which was about 7%, now there's people that want to sell and people that want to buy even more. So that makes this volatility increase. So during the strong bull, this was a very low volatility. It was like 0.8%. And now, just 20 days later, this is like 1.9% is the daily ATR. So that's more than twice as volatile just 20 days later. And it's because as people get nervous or eager, the size of the daily bars change. So we've got to recognize that's the kind of market that we're in. Strong bull, orderly sell-off, critical state. And now that I've obscured the entire screen with scribble, try to make sense of that. All right, so now we're going to look at some specific support levels. Sorry. So we have the low of the day, and price was very close to the low of the day, so that's discouraging for tomorrow. We have the we have the lower skin of the dragon at like 336.9. We have the Z minus 1, the boundary of the river, and we have the true price, the RL10, which you can see is now co-located. So this is a really strong support at 334.2. So if the market opens and then sells off here, I want to get a short position. If it breaks through the skin of the dragon, I want to get a second position short. And if it breaks through the RL10, I want to get 3 positions short, because then if it breaks through this combined 30-day and 10-day low, it's Katie bar the door, and I will have had market's money to pay for my 4th position as it breaks through Z2 and takes off. So that's how I would increment onto the short side based on market condition. And so then using that logic chain, I would say, if the market were down, which one of the sectors is the worst? Is it tech? Is it finance? Is it energy? It wouldn't surprise me if it was energy, because energy had been horrible and had a really strong move today. So maybe that's all it has. And then it starts to roll over, and then people start selling to preserve profits, and then that thing drops. Or maybe it's XL, and so that's energy. But maybe it's finance, because finance has had its day in the sun and is now back here in the middle. So it's easier to believe in a sharp sell-off. So I could see how finance could be the worst, or tech, because people are trying to preserve the gain. So, or maybe it's materials, which have been very strong. One of those 4 sectors will be worse. So if the market's down, I then want to find which sector is doing the worst, and then find the symbol that's doing the worst inside that and get short. Or I could just play TZA to the long side and just play the inverse sector. That would be the inverse Russell. Or I could play SDow and just play the inverse leveraged Dow. So when the market is down, I have a couple choices. I can play the inverse sector, or I can just find the worst performer in my radar screen and then short that one. So that's my scenario if today's sell-off continues to tomorrow. And I've identified through my trade framing all of the places that give me indications that the market is getting progressively weaker. Each one of those is a decision point that the market communicates with to me. It uses the decision point and the behavior at each one of those. Now, each one of these could also be a support level, like it could sell off, hold support at the bottom of the dragon, and go up. It could come down to the Z1 and the RL10 and then hook back up. It could come all the way down to the 10 and the 30-day low and hook back up, just like it did here. It sold off through all of these indicators, hit the 10-day low, and moved all the way to the far side of the dragon, which is a move from 331 to 344. That's $13. $13 on 330. 10%. That's about 3.5% over a 4-day period. That's a pretty good move. But today was the first day it started to sell off. So we had strong bull, measured sell-off of 7%, and then a recovery of 3.5%, and it started to roll off again. Oh, that's not good. Here's a high, here's a lower high. That means if this lower low, if this breaks, then bang, that is the collapsing dragon, and that's the trade you want the most of. But if it were to hold here, then you would see 1, 2, and now you have a double bottom. Now what happens if it comes back here? Does it reverse again, or does it get higher? Does it get through here, or does it fail here? So what we're doing now is looking at market conditions to guide us through the tactical decisions. Now, the beauty of this is that by emphasizing the day trade, I'm not getting caught in premature swing trade positions, and I can take advantage of the increased volatility in the size of the daily ranges and emphasize this part of my hybrid trading repertoire. Okay, so that's what I want to say about that. So that's the downside case. But what's the upside case? Because we want to trade frame this in both directions. Let me know if you guys are finding this helpful. And again, I spend more time on this than I do on any individual trade frames. Why? Because the market itself contributes 50% of the variability of all the things that I trade. So if I get this right, I've done half the work for all my other symbols. So there's a good payoff on this. All right, now what happens if it goes to the upside? Like it holds support here and then just starts moving up. What are the indicators of that? Well, it's got to get through the Bollinger Band mean and the spine of the dragon. It's got to get through the daily high. It's got to get through the upper skin of the dragon. It's got to breach the Z1 and the PSAR and tomorrow's RL30. It's got to get through the peak of the dragon, which is this one. It turns out that that one is really important because this was the statistical turning point. All of this price action up in here was just excess noise. This is really where price turned, according to this theory of indicators. To a lesser extent, the RL10 peak operates in the same function. It's just that the dragon is first and then the RL10 is second. So once it gets through the dragon, I feel good. If it gets through the RL10, I feel great, because then all it has to do is get through the 10-day and 30-day high, and it's an all-time high. And that's only 5.5% away. So that's what our trade frame looks like for the market. Okay? Hopefully you found that helpful. All right, so let's take a look. At our sectors. Following our usual ritual. So the S&P was down 0.38 today. Treasuries were also down, but only 0.3. The Dow was up a fraction at 0.16. So the large cap conservative Uber caps did well. And then the speculative Russell 2000 did the best of all from the broad U.S. sectors. Okay. All right, so now let's take a look at the sectors that did well. So again, the S&P was here at minus 0.38. Now we have a little cluster right around the zero line of materials, XLB, silver, emerging markets, and consumer discretionary. So just fractionally better. Then we have a cluster in here of Mexico, Japan, and Brazil between 0.2 and 0.6. Then we have finance and clean energy at 1.1% gains. Energy just crushed it today. XLE, the energy sector, was up 4%. Oil was up 4.3%. And XOP, the gas and energy exploration ETF, was up 5%. And then Devon Energy, our little mid-cap, our little buddy, mid-cap buddy, was the best performer of all. And that was true all day. And that's really something I want to stress. So take a look at what this little sector analysis and target analysis can tell us. What happened today was SPY was down a fraction, but the strongest sector was XLE, powered by gains in oil at like plus 4%. So this was down minus 0.3. And XLE was by far the strongest. And a subset of that, XOP, was even better. That's a subset of the broad energy. And that was up 5%. And then Devon Energy, the US mid-cap guy, is up 6%. So you can see that logic chain that market flat or down a little, but energy uber strong, Devon even stronger. So it was like 2% better than the broad sector. Now, the other thing that we'll notice, if we can, is, let's see, where is my, so finance was better. It was up 1 and some change, so up plus 1%. Well, there's Goldman Sachs, up 1.3. Goldman Sachs. So that has a little bit of extra juice compared to that. So the S&P, SPY, minus 0.3. So there was real buying pressure that made the finance win, and then people were also buying Goldman. And that's all we see for the, for the finance stocks that are in there. I'm also noticing that you have U.S. Steel, Nucor, Caterpillar, Alcoa, all better than XLB. So XLB was better. XLB at 0.08 was better than the S&P fractionally, but now all of these little gizmos, all of those companies have relative strength compared to their sector. So all other things being equal, I can go in tomorrow to say that, well, whatever the S&P was today, XLB was a little bit better, but XLE was much better. And if that logic holds again tomorrow, then it wouldn't surprise me to see Devon have another good day. And so that's what I mean by a continuation pattern. Is that I already, just by assessing the trade today, I can already start building my trade logic for tomorrow. Clear on that? So now, if I look at the things that underperformed, again, I can see the S&P here at minus 0.38. Now I'm going to look at all these that are highlighted into the red. Here's consumer discretionary, minus 0.56. Wheat and precious metals, minus 1.1. Here's technology, minus 1.55. And the FANGs, and again, that's Netflix, Facebook, Apple, Amazon, Netflix, or I said that, Google. So that little collection is NY FANG, and that gives you kind of the modern cloud champions. And then way down here, I noticed the triple techs are down 4.5 and 4.8. So they're 3 times So TECL is 3 times XLK. So XLK was 1.5 times 3 gives you minus 4.5. And then TQQQ is the NASDAQ 100 triple inverse. So it's down slightly more. And now as I look at the companies that are in here, I see the tech losers today. NVIDIA, Facebook, they're down over 3%. Apple, Amazon, Microsoft, Tesla. These were the things that were leading the way the previous 2 days. So you will recall we had a strong bull, a 7% sell-off, and then sort of this grinding 3.5% gain. Well, a lot of our tech leaders were responsible for this win. But that's all of these guys. All of those today were part of this sell-off. So if the guys that were leading the way up are being undercut and that's pulling the market down, would it surprise you if they were also bad tomorrow? No. But that might also just been a small dip and then go, and then I have a low and a higher low. So this is becoming a critical state. What does it do after this little 3.5% bounce, which is half of the 7% sell-off? So you can see I'm using trade geometry here to start anticipating the size of possible moves tomorrow. So if it sold off 1%-ish today, and the ATR percentage is 2%, that means tomorrow it could come down and retest that 10-day low with no problem. That would be unsurprising. But it might also just as easily move up 2% and get halfway up, 2/3 of the way up the stack here. That would be unsurprising. That's the exact definition of a critical state. And then the last thing was, well, what if it just grinds sideways and becomes a Z3P? Well, then you're not going to make or lose much money at all until it starts to make the move. So what I've done now is I've constructed a logic chain with SPY. I've anticipated what it can do up, down, and sideways. I'm leaning towards XLE being better, XLB being slightly better. Tech was worse. I'm trying to remember where XLF was. I think, XLF was probably up in here. So tech was worst, then basic materials, then finance, and then energy. So that's my tentative frame of reference, my scaffolding going into tomorrow's trade. And I just know that with the S&P in a critical state, equal probability that it goes up, down, or sideways. And I just know from my scaffolding what are the triggers to declare it's that kind of a move. And basically it's the daily range and modified and supplemented by the other things we looked at. Okay, so that's what I want to say about market conditions. Before we get to the report, I want to debrief some things that happened today. First one I want to debrief is trade frame from Bill. So Bill Scheit is our drumming sensei, and he's putting together that 10-song album of drumming meditations that's going to be accompanying some of the narratives that I've done in the hybrid trading. So it'll build like a little meditative state, and it'll teach you some drumming and relaxing and all that stuff. It'll be fun. The one about the zero state was a lot of fun. I think it's going to be good. Well, at the same time, Bill is doing a research report for the annual research weekend, which again, I am just negligent in getting you guys info. It's probably going to be around Thanksgiving. I keep pushing it back as I get busy. So he and Jeff, who's a trade station programmer par excellence. In fact, I have him collaborating with my son on how to learn Python so I can add to my son's programming skill set so he can take over for me. He's finishing up his dissertation. He's over the tipping point right now. The end is near. So this is Bill's trade frame, and I've added the items in yellow. Let's see if I can get this. So I added all these items in yellow, so it's not going to let me do that. Okay, fine. Two can play that game. All right. So what Bill noticed from the daily report was that the risk Z was down, but it was flattening, meaning that the risk Z had, it was below the zero line, but now it was starting to flatten, meaning that this is potentially a turning point, and it goes from winter to spring on the risk Z. So that got him interested in the tech leaders. And so this is TNA. This is on 2-minute charts. He and Jeff are studying the SSC, supported spring crossing, and they have made a little trading robot out of this thing so that they can generate automatic trades to take their own, say, intuition or trader quality number out of it. So they're at about 700 plus case studies so far, and it looks very promising. A mechanically traded SSC on broad indexes that's positive expectancy. How interested in that are you? I know I'm interested in it. So the first one he did, now they're trading it with the TNA TZA pair. Okay. So TNA is the triple Russell long and TZA is the triple Russell short. They're only showing us this on TNA. They're taking the signals in both directions on TNA. So this is a supported spring. This is a supported spring crossing on TZA, but they're showing it on TNA so that you can feel the flow of this pattern, and that's legit. Now, the first trade ended up being basically a scratch. They executed TZA on the SSC with an initial stop at the PSAR. I guess that would be probably this one. And then trailed with the PSAR, which is like the aggressive sniper part of the Wu Wei exit, which is fine. So they're testing the utility of the PSAR. And I think that's a good thing to know, because then that'll tell you if you want to be relaxed and then accelerate or just trust the PSAR. And so we'll have the law of large numbers to be able to tell us, well, robotically, if you just trade this thing every day in both directions, following the rules, what do you get? Well, right now it's positive expectancy, which is pretty good. Now, what I circled on here in yellow was this notation here, that the PSAR flip occurs here. And so I think the correct entry should be here and not here. So that difference makes it a minus 0.03 instead of a fractional win. But I really want to see what their rule sets are to verify the code, because that's like that looks like it's about 3 bars late. So I got to see what they're doing with the entry on that. Then the second trade. So that's their exit. Now the second trade it's almost immediately a stop and reverse. And here's the SSC. Trade number 2, initial stop at the PSAR, and they're just in this exercise. What they're doing is taking those 700 trades and studying just this exit strategy. What happens if you just trade the trail with the PSAR? And it turns out to be pretty good. And an orderly exit for 1.22. Now, if they had their parameters they were testing right now don't take the signals after 11 because they want to go from 0830 to 11 and get that 2.5 hours of prime time for big moves. But they can also just as easily run this and say, yeah, here's where that exit or the entry would be on TZA, and then this one should produce, if that's 1, and there's your exit, that's probably 1.0 to 1.5 additional. So the next thing that I do when I'm checking their oil on that is I then take a look at, based on where their decisions were, where were we in the 4 seasons? So this is about where that entry hit on the 4 seasons of MACD, whereas here's the turning point. Here's the turning point into the spring. There's the actual peak of the summer. And so the PSAR flip happens right about here. This is an intermediate point, and then that's where their execution was, already into the skin of the Red River. This exit and this entry are all kind of in the sweet spot where it fails to fall further and gets flat and is starting to roll up. So I really like that entry. That entry looks correct. And then you'll notice that on the exit that they took, comes right down into here as summer rolls into fall and enters the Red River. That is proof of principle of the timeliness of that indicator. It tells you when it's okay to stay in. It tells you here up, it's now abnormal. This is the normal space between the edges of the skin of that Red River. And this is where it's abnormal gains, and this is where you want to be thinking about stalking, and then the PSAR just takes care of you. So notice how the difference between normal and abnormal. And then this one would have gotten you short right at the correct spot as summer became fall and entered the river. You could have even added a second position here, and then the PSAR would have protected you and then Wu Wei. So this little 1.0 could have been almost a 2.0 if you take advantage of the winter being harsh. And then right here, you get a signal that it's starting to flatten out. And then this is where the PSAR exit hits. So I like the visually appealing. I spelled that wrong, I think. Looks funny. Their use of the dark colors is very attractive. I noticed that Jeff has programmed this so that when you start getting a narrow pinch, that red outside turns to yellow, and it's alerting you that, hey, SQC, baby, and now a breakout in either direction could be very handy. So very nice trade frame and case study, and that's a preview of coming attractions for the Platinum members who will get the research products from the research weekend. Kim Anderson has about the first 70 slides of her volatility trading system prepared, and she said in about a week I should be able to review it. So I got a couple from Bill already. It's got this one from Jeff. I'm going to trick Bob Rourke and Jim Carroll to update their stuff. We've got a number of you out there who should be thinking about contributing your learning journal and histograms and trade stats from the hybrid trading, which will get you access to the to that workshop on account of doing the work. So there's an incentive for you to start preparing your monthly check-ins and system summaries. So we're looking to do that in November. So if you're in the sound of my voice, you have your marching orders. Looking at you, Luke. And Lisa, especially you, and Ken Hum. I'm expecting great things from you, buddy. All right, so I want to talk about 3 other case studies that I think are absolutely instrumental to understanding what we're doing here. All right, so this is Twitter. As you know, Twitter has been one of my targets of interest because during the wicked run-up of all the tech leaders this summer, Twitter belongs in that category, but didn't explode as much as, let's say, Tesla, Facebook, Amazon, Google. So I have felt like these guys are a lock for the future because they are the de facto government. They are the only journalists out there. They're the infrastructure that support all the individual journalists. The fake news on both sides have made newspapers, reporters, and TV talking heads absolutely unreliable and a waste of time. The only thing that is even close to the truth is what's being reported through Twitter. So Twitter has a lock on that distribution channel for the future. So Twitter, therefore, has been on my radar. And so my logic chain for this is SPY. And I'm going to say QQQ versus XLK. And then Twitter as part of that. And it has to compete against, Apple, Microsoft, to name a few. So that's my rapid logic chain, and it turned out that Twitter was just crushing it today. So here's the close yesterday. 4 o'clock was it? Or I guess it's here. Yeah, sorry. And here was the MMRB from the, it's like the idle. When there's no directionality, it's just grinding along, robots trading each other, price just wiggles around here. That MMRB is the size of this MMRB. So we get a gap up, and now notice the VWAP is just racing north. Here's the low of the day. Here's an MMRB move off the bottom. So I just buy that. It's by far the best symbol in my stack of 50. And so now I just take the MMRB until it catches up to the PSAR, and then it's to here. And now, at this point, I made a sniper decision to accelerate the Wu-Wei exit, which really, the Wu-Wei exit would not occur until the PSAR dots had been, so I get 3 PSAR dots passed. So the regular Wu-Wei exit would be here, and then zoom up to here, and then lock it in. But I didn't want to wait the extra 2 or 3 beats because this thing had moved up and then gave me a doji. And I said, you know what? I'm not going to let that come all the way down to here. I said, sniper, and just moved it up, and I locked in a little fraction below the low of the day. And then just left that in place. And then it opened and then started going up. And this thing proceeded to go up for another good distance. And at this point, when it broke out and went higher, I added the second position. And then that was another reason to accelerate that sniper. because if my exit is hit here, then the gains that I made from on the first position will offset the little losses I took on that one, and then I will still have a positive net. But now I've got two positions in as this thing is starting to go. And once it gets above that blue line, I'm just going to raise my stop and lock in the gains there. So I'm going to have a 2x science project. So that's an example of find the mover supported by a logic chain and trade architecture, and then studying price action. Look at this thing expanding and the VWAP going. That's a no-brainer. Best thing in my stack, and it's going up, and it should go up, and it's the best performer. Easy. Compared to all the other decisions I make. I should actually say Twitter was the second best performer. Now I remember it was Devin was the best. All right. So here's Devon Energy. And here is this is like a supported fall crossing trade frame and entry in this first section. So here is the open. And so here is yesterday's. And if you followed along the quiz, number one is identify the MMRB from yesterday's idle time. This is where the Z3 had pinched. So this is just idling along in here. That's my MMRB. And you're going to notice that when I do make my entry, it turns out that MMRB is co-located with the PSAR flip. So that feels good. So number one was the MMRB. Number two was the open, and then the immediate price action starting to go up. Number three is I see there's a PSAR flip. The previous PSAR was here, and then it flipped down to here. So number three is the PSAR is flipping up. Now at number four, I noticed this. The first burst was up, second burst was down to the Bollinger Band mean where it held support higher than yesterday's close and right at yesterday's VWAP. So it's holding support where it is supposed to, right at the Bollinger Band mean. And now it breaks out across the VWAP. Could have gotten it here at the PSAR flip, but I decided to wait for this because this now breaks out of the RL10 and it's an MMRB off of the support level. So there I go. So now I commit to the, so 4 was the noticing the reverse up. 5 was noticing the crossing of the VWAP. 6 was the PSAR flip and the entry. So now I've committed to the Wu Wei exit. So that remains in place until, and then I'm just noticing the PSAR mark its way up. And here is where the entry was at 936, and my stop is down here at 926. So my initial risk is 10 cents. So on $400, I could have up to 4,000 shares. Is that right? Yeah, up maximum position size of 4,000 shares. Now I notice it gets into this little holding pattern. So what? My stop is still where it's supposed to be. Now I get 1, 2, 3 PSAR dots above my entry. That triggers my sniper move to the Wu Wei. And now that's going to remain in place at like 939. So from 936 to 939, that's 0.03. And if I'm using my $400 and 4,000 shares, that's $120. No matter what else happens, I'm not losing money on that trade. Now, the sniper comes up to here, and now the Wu Wei exit strategy. So number one was that I put the initial risk at the PSAR flip. Number two, it stays in place until I get 3 dots above the entry, and then I move the sniper at decision point 2, move the sniper to that 4th PSAR dot, which is number 3. I move it to the PSAR dot and keep that in place. Number 4 is that the sniper is going to follow the PSAR, and then I'm just going to project the Bollinger Band mean for the manager. So this is the sniper exit. Or if I decide to accelerate, that would also be the sniper. But the sniper starts off grounded in the PSAR, and then the manager exit is simply, I'm just projecting, the Bollinger Band mean. If this thing takes off, then that Bollinger Band mean and the PSAR would accelerate. But that just shows you the difference in the projections between the sniper and the manager. So what we have on that case study are two things. You have a picture of the supported fall crossing and how you frame that initial trade for entry and the initial entry and initial risk. And then you have a demonstration of the Wu Wei exit strategy, and off we go. Now, there was, hey, Ken, could you put a second? Yeah, you could put a second position in here, or if it breaks out above here, but that's a decision you can make. But if you're just playing it right by the numbers, that's what it looks like. And to be honest, at this point, I would have a real urge to have that second position in, and then have a stop. I would not be offended if you move that stop right up to here. And I wouldn't be offended if you move that stop to here, spine of the dragon or the Z1, and then pick that. That's your call. But the Wu Wei exit is what you see demonstrated here. Okay? So good lesson for you. Let's see what's the next one here. Oh, so let me say, yeah, Devon Energy ended up being massively good. As we saw, it was like up 6%. So that trade went on for a good long while. So Nikola was another one that I have been shamelessly trading intraday on the long side. So the first thing I want to do is show you the connection between the daily chart trade frame and a critical state, right? So here's the daily chart on Nikola. So we had something like a 10-day high up here outside of Z3, and it already started closing. And then we put last week a critical state. I called this, there's a new term of art, the breakout box. When you see those, that's me framing a really tight critical state, and I'm being ready to go this way or that way when you see those tight boxes. So this is one where it opened, broke down, and then you could be short here, and you get this move down to a 10-day low, which is at Z3. So this thing went from Z3 to Z3 in that one big move. That's awesome. So now when it finds support down here, Excuse me. Try that again. So now when we see it finding support down here, that becomes a critical state. Just like we identified this as a critical state because of its proximity to Z3 and its proximity to Z3. Now the probability of a big move in either direction is increased. So what it did was the next day gave a little doji, so that's also a critical state. And then what it did today, at the time I took this snapshot, it had come back down to that 10-day low. It gapped open down here, just, you can't see it from here, but just out of the yellow zone, and then was going straight up. And that is a move from about $30 to 34. That's plus $4 on 30. That's almost 13% from that low. A 13% move in a straight up move. So that's plus $4. Now, we had identified this yellow box when we were looking at this critical state. We said, well, it could, a move up here to the yellow box to like Z2 would be the maximum feasible upside move. And it might take 4 days to do it because it took 4 days to sell off. But this was kind of the playing range. And here it's got 1/3 of that move already on one day. 1, 2, 3. That would be cool. This is 52. This is 30. That's $22. That's a 60% move. That's why I'm interested in Nikola. So the point I want to make is when it gapped down to the bottom of that yellow box and started to move up, that made it very interesting. So let's zoom in and look at that. Now, that blue circle that you saw on that previous, that was this on this other thumbnail, that little blue circle you saw where it gapped down, this was the gap down move into this circle. It gapped down to the VWAP and then was mucking along in here in this channel between the beginning of the yellow zone to the upside and this solid support at the bottom of the RL10 and what was a PSAR flip. And what I noticed was in this region here, this whole region was failure to fail. Now, if it breaks down at any time in this region, I'm going to be short on that collapsing dragon like anything. Because if we look back at that daily chart, that was the gateway to another 10 or 20% sell-off, but it didn't. And in fact, what it did was it gave us kind of Z3 pinch. And then here is the MMRB and the PSAR flip. And just buy it, and it breaks out to Z3. So the Wu Wei exit gets you to here, and the sniper or the manager. I would not be offended if you had moved up into here, or even took a Z3 and started to reverse and just cut it right there. And now you get all the gains I got, but now in about 5 minutes. And look how fast you could get that to, in 5 minutes, you have your risk out. So the point to be made here is the Z3P entry at a critical state, the sniper exit, and the manager's exit. Okay. Again, the points on a clean screen. This yellow zone, this big yellow box, was the opportunity space that we identified in the daily frame. This line here at the beginning of the opportunity space is a critical state. This little gap down creates the moment. And then because it failed to fail further, that makes this Z3 pinch breakout. Well, why not? Just give it a try. And then that becomes your Wu Wei exit to a sniper, or then pick up the Bollinger Band mean and you capture. The manager captures $1.10, the sniper captures $1.50, and that's really about the same thing. If you got the 1, 2, 3 exit, it's just about the same. And even using the Wu Wei exit on a 50-cent initial risk, you only have 9 minutes of open risk by the time you lock in your gain. And 50-cent risk, so that ain't bad. Now, to go back to the Devon Energy trade, right? I showed you what this looked like during the day, the initial entry. So this was, that was Devon Energy and the initial trade. So Devon Energy did nothing but work all day. So this is that first trade, and getting that entry in that little, when it crossed the VWAP and right in there. And then the Bollinger Band mean exit, the manager exit gives you a really nice trade. And then supported spring crossing and the manager exit, and supported fall crossing and the manager exit, and a supported spring crossing and the manager's exit, supported spring crossing and the manager's exit, supported spring crossing and the manager's exit. I mean, god dang. All day long, energy was crushing it, and Devon was crushing energy. And that's all it did all day. Find the mover and exploit it. That's just with one position, and that's 15 R, 15 execution R. Find the mover on a day where the market was down 0.4. There's 15 R in one symbol. Find the mover, and it started with finding the mover right from the open. So that's what I want to say about that. Those 3 case studies, Devon Energy, Nikola, and Twitter, is an entire workshop for you right there, plus the opening remarks about logic chains. That's a 1-hour workshop. I should charge $5,000 for that. Maybe I will. Okay. Let's get this quick look for tomorrow. Bullish normal, overbought, intermediate term over at the low end of average, almost oversold, and now a little bit of recovery. Not as strong as yesterday. And the risk Z is still cautious. Say, this could be a swing up, could be a swing down. We've seen both of those events in the recent past. Max pains are still all of the techs: Google, Facebook, Amazon, Apple, and Citibank. How did Citibank even get in there? It's all the techs. And the non-techs are the ones that are holding up the best. Risk C is still showing a risk off, don't swing trade. It's abnormally vulnerable. Just a handful of dojis in the Dow Tactical, plenty of auto framers to work with, including Apple at 5-1, and it's been horrible for 1 day and 10 days. That's worth framing just as an opportunity trade. You don't think that's attracting sharks that smell weak hands? That's where the buying pressure is going to come from. Microsoft in the same condition. McDonald's, on the other hand, is a store of value. And Caterpillar is showing some strength. The non-tech safe play. Lots of dojis in the ETFs. There's a channeling in technology that's good, and it's 3.9-1. So tomorrow's going to be a big day in tech. I just don't know the direction. But you watch. All of those FANG companies were down. I think they go up tomorrow in a big way because people want to buy quality. Or is everybody afraid of everything? I don't know. But Japan's attracting attention because it's not the U.S. And oil and energy were both big today. Possibility of a second move, and so was XOP. A big one-day bounce after a long period of getting smashed. Lots in the auto framer to choose from, plenty. Lots of good daily squeezes with some names that we recognize. Salesforce, Gold, Walmart, Disney. There's Apple and the S&P in Brazil. It's a critical state tomorrow. Dominated by fall and winter. I'm still waiting for treasuries to make that move. I just am biding my time and suffering. Again, the Dow is also being dominated by fall and winter. 3M and McDonald's should be very interesting. AXP, Disney, and CAT because of the strong MACD Z-score. McDonald's crushing it. Honeywell in tech land, stealth. Merck and Walgreens. IBM with the big bounce. And then Apple suffering with the breakdown. Procter & Gamble suffering with the breakdown. Those are probably overreactions. Japan, metals and mining, industrials, small caps. Look how strong oil, exploration, and energy were. That's how strong that sector was today. No surprise that Devon dominated in that. So Devon is my number one thing to be ready for tomorrow when I'm maximizing day trading. I am the coyote, the master opportunist. Speaking of which, I got to go walk the dogs here pretty shortly. We saw 3 coyotes 2 nights ago, and my dogs wanted to get a piece of that. They're so dumb. But I respect the courage. But that's why I'm holding the leash. Measured pullback back to the long-term stable slope of the S&P, and that produced, the last time it was there when it held, it gave a nice gain. So that's the story for the upside. But then it could also be this breakdown, which I don't need to tell you what that was like. Okay, that's everything I got for you. Critical state holding support. Slope of the RL10 turning after a 3 sigma adverse move, and the slope of the 30 back to the long-term average, and the long-term stable bull still in effect. Okay, that's what we got. We'll get it published and posted. I did a 20-minute speed run on the swing portfolio that's still uploading at YouTube, so that'll be available as an additional video for today. So there's a lot of good ideas on that one, just from the end of day trade, swing trading for the silver subscribers. Okay, that's all I got.